We do not have a regulator that formalizes all of non-GAAP, and significantly, it's not audited as well. So we will move on to get an investor perspective on this complex topic, and to do that, we have Stephen Gray, Managing Principal, Gray Value Management. Stephen is the founder and managing principal of Gray Value Management, LLC, a privately held investment entity that oversees the Gray Value Opportunity Fund, an investment partnership dedicated to generating absolute returns through a focused portfolio employing long and short strategies across all industries and markets globally, including equity, debt, commodities, and derivatives. Let's go, Stephen.
Thank you. I'm very happy to be here today. Thank you for inviting me. It is a privilege to participate. Slide, please. Because I invest for a living, my views on financial reporting are heavily influenced by those responsibilities. I operate where policy and enforcement meet practice. I put it that way because I absolutely cannot do my job unless the SEC, FASB, the PCAOB are able to do theirs. To put a finer point on that, I cannot possibly fulfill my responsibilities as a fiduciary if those entities are not able to pursue their mandates. More broadly, I think that we all grasp that the less investors trust the reported financials, the less they will trust the market overall. We all also know that the more suspect the accounting is, the higher the cost of capital. That's the high altitude take. What's the view at ground level? All accounting conventions, GAAP, non-GAAP, IFRS, are an interpretation, an expression of an underlying economic reality, which means that any analysis of a financial statement is ultimately an interpretation of an interpretation. Whether it's GAAP or non-GAAP, I know it's all at least once removed from the financial reality I'm trying to understand. If there's nothing I can do to diminish that distance, if it's a feature of the system, not a bug, then as an investor, I welcome any additional information that might help me come to a more comprehensive financial understanding of what I'm looking at. That includes any non-GAAP numbers management might want to offer. Now, let's be honest here. It's not as if any of us are mistaking their intent. Corporate management isn't offering non-GAAP numbers because they make their performance look worse. Non-GAAP measures are essentially a form of financial spin. So when we talk about, to quote the program, the risk that non-GAAP metrics may be presented in a way that emphasizes a more favorable outlook than GAAP reporting alone might suggest, my response is, of course. That's why they're doing it. But I don't say that as an indictment, because as long as it is consistent and not fabricated or technically inaccurate, more information is always better. In my experience, simply contrasting the GAAP financials with the non-GAAP figures can yield important insights. By way of concrete example, next slide, please. Avaya is a company I invested in and later wrote about in the Financial Times. What you're looking at is a snapshot of the article I wrote back in August of 2022. Avaya got my attention because it had just been through bankruptcy and it was a global leader in the contact center market and UC, Unified Communications, helping businesses integrate all of their communication capabilities. With a much cleaner balance sheet, an already attractive investment opportunity became only more so when demand for UC skyrocketed as a result of the pandemic. So Avaya became a big position for our fund, which for us is about 10% of our capital before taking into account any appreciation. And the stock did appreciate significantly. But as we followed the company's performance, carefully reading the 10Qs and 10Ks, we began to notice something. Based on their own metrics, management was killing it. But based on the GAAP numbers, their performance seemed oddly anemic. And with each passing quarter, the disparity between the two kept widening, with the GAAP-based performance continuing to be oddly feeble and well short of what I thought were reasonable expectations for their performance. Here's my spreadsheet on that math, which ran with the FT article. Next slide, please. So we blew out of the position. We sold it all. We made a nice profit, but of course the stock kept climbing. That's what always happens when you sell. We kept following it, And in June of 2022, they announced that with the help of several major Wall Street banks, they were going to raise about $600 million in debt. Less than 2 months later, Avaya slashed its forecast by 2/3 and fired the CEO, citing, quote, substantial doubt about the company's ability to continue as a going concern. The notes that had just been issued lost half their value, and a year later, the shares became worthless when Avaya went bankrupt. The investment bankers and those who purchased the notes predictably went ballistic, claiming they were defrauded, misled. But here's the question. How could anyone claim to have been misled when all the numbers they needed were in the public domain, readily available? There's a spreadsheet. That's all based on the filings. Even if some wrongdoing was occurring behind the corporate veil, you didn't need to be privy to it to see the train wreck coming. It was staring you in the face if you bothered to look. More on that in a minute. Next slide, please. Prior to launching our current fund, I was the CEO of a single-family office. And in that role, I built a position in a bank called Tier 1. We were well into the great financial crisis, and I came across it as I was looking for underpriced opportunities among the potential survivors. Not a huge bank, but the second largest in Nebraska. And although the share price had, like most banks, been crushed, Tier 1 had a remarkably healthy balance sheet, including its loan book. I dug deep into the numbers and even paid a forensic accountant specializing in financial institutions to check my math. Both of us came to the same conclusion. If the numbers were accurate, it was a great investment opportunity. So I flew out to Nebraska and met with senior management just to make sure I wasn't missing something. And the first thing I did when we got into the conference room was tape this sheet to the wall, and I've got a hard copy because it wouldn't really work as a slide, but just by way of visual aids.
Nice work.
That's a blow-up of a spreadsheet of every publicly available data point on their loans over the preceding 12 years. I pointed to it and asked, what am I missing? As we went through the numbers, they insisted all of them were accurate. The next time I pulled out that sheet, I was back in Nebraska several years later. It was in front of a jury. After getting a hold of my research, the SEC and DOJ asked if I could assist them in the prosecution of Tier 1's management. Now, a common complaint following the GFC was that not a single bank CEO went to prison. Next slide, please. Not accurate. I spent a week in Nebraska walking the jury through the numbers in the course of events, and following his guilty verdict, the CEO was sent to Leavenworth for over a decade. My closing comments. Now, Avaya and Tier 1 were two very different situations, but they had one thing in common. Anyone could have done what I did. And that's not false modesty or some kind of humble brag. Anyone with a basic grasp of accounting and financial reporting could have made the effort. Which brings me to my final point, and perhaps the elephant quietly lingering in the back of the room. Why didn't they? Why don't they? How we police financial reporting, including how GAAP and non-GAAP numbers are presented, is crucial. But to what degree does the investment community look closely at either anymore? To the extent that the investment process has been automated, with capital pouring into ETFs and other passive vehicles based on indices, themes, and exposures, the asset management industry has achieved impressive economies of scale. But in the process, they've effectively institutionalized complacency. Now, the more uninformed or indiscriminate money there is in the market, the easier it is for someone like me to identify and exploit security-specific mispricings. We've always relied on that profit incentive, focusing on individual securities to ensure that the market will, in aggregate, continue to efficiently, accurately price risk. Which is why the topics we're exploring and debating today are, in my opinion, so crucial. It may be fashionable to be dismissive of those who set the accounting and reporting standards and enforce them. But I know based on what I do every working day that we take them for granted at our peril. the buck really stops here. It really does stop here, as will I.
Thank you much, Stephen, for pinpointing how important this area actually happens to be.